Hello and welcome to the 7th of our ACCA P7 Audit and Assurance lecture recaps. Okay, so this lecture was a little bit of an introduction to the methodology behind auditing. So there were different types of methodology available to us. Let's set out what the ACCAs actually say about this. So ISA 200 says that it must be a risk-based audit. ISA 315 says we should understand the entity, we should plan, and again that it must be a risk-based audit. ISA 330 says that we should use procedures to reduce audit risk. So all of these are pointing us in the direction of risk. So approaches then, let's look at this risk-based audit. So a risk-based audit involves inherent risk, which is our business risk, times our control risk, which comes from having weak controls, times our detection risk, which is the risk that we don't detect a misstatement, and that will all equal our audit risk. Now we'll be looking at this in some detail, so don't worry about it in too much detail at this point, but it's inherent risk times control risk times detection risk equals audit risk. What is our audit risk? Well, the audit risk is the risk of giving an inappropriate opinion, i.e. that the financial statements don't present a true and fair view when they do, or that the financial statements do present a true and fair view when they don't. Okay? So, assessing that risk then. Well, inherent risk, we were looking at things like financing of the business, the industry it's in, the regulations it adheres to, and maybe targets that it sets for itself. Control risk, we'll be looking at things like the systems in place, the training in place, and segregation of duties. Detection risk then, well, we'll see if we've got a tailored audit, if the team are suitably experienced, are there safeguards in place, and are we suitably independent. All of these will affect our detection risk. And that will all relate to our audit risk. Remember, that is the risk of an inappropriate opinion. Now we'll look at this in a little bit more detail whenever we look at planning. So another approach to audit is a top-down approach. The theory behind this is that we assess the business risks at a high level. So we take an overview of the business in totality at a high level and we assess what business risks there are. Then we decide, well, how are these business risks likely to be reflected in the accounts? We then focus on those risks. The effects of a top-down approach are that we test the controls at a very high level, and we also focus on the control environment within the business. We'll undertake analytical review, we'll use that quite a bit, and it'll give us an understanding of the business as a whole. Substantive tests then, well, we'll have a reduced need for substantive tests or tests of balances because we'll have focused our audit in on the high risk areas. We can't eliminate substantive tests, but the level of them will be determined by the tests of control and the analytical procedures that we've undertaken. This top-down approach is the required approach under ISAs 315 and 330. So thinking about methodology, we have to take a risk-based approach and we have to take a top-down approach. So we'll assess the risks at a high level, we'll see how they should be reflected in the accounts and focus on those risks. This is the required approach under the ISAs. Other approaches or other types of audit you might hear or see in the exam. Systems audit, well, this will be a systems review. The risk assessment will undertake to find out whether the systems are effective during the period that is being audited. If the systems were effective, well, then you can have some comfort over the information that's being provided by them. So it will increase or decrease the substantive testing required. Again, remember that you can never eliminate substantive testing. You always have to undertake some form of substantive testing. A balance sheet approach. Well, what you would do here is you'll assess the opening and closing balances to see whether they're reasonable. You then decide that, well, the balances in between have been audited on the same basis last year, i.e. the opening balances were tested, the closing balances were tested, and we'll assume that the bit in between should be okay. So what we're basically saying is, if the opening balances are okay and the closing balances are okay, well then the bit in between should be okay. Now again, this is a bit limited in terms of actual testing, and there always has to be a risk assessment under the ACCAs. Transactional cycle approach, well this focuses on the transactional cycles such as sales, and it then gives you comfort over any linked balances, for example receivables. So that's focusing on the actual transaction cycles within the business. Directional testing, well this focuses on likely errors. For example, assets are likely to be overvalued, liabilities likely to be understated. That's directional testing. You focus on the likely errors or where they're likely to be, and then you decide what you're going to test them on that basis. The pros and cons of this, well, on the upside, it's very straightforward. It has got that risk focus that we need under the ACCAs, and you can use it in conjunction with transactional testing to give quite good comfort over the balances. On the downside, it's often misunderstood. The actual way to do it is often misunderstood by auditors. It can lead to over-auditing because you tend to just test all of the balances, and it will need modification depending on the audit or the entity that you're auditing. So that was our lecture on audit methodology.